Mutual funds versus treasury bills versus stocks. Which should you pick? If you have ever wondered which investment is right for you, you are not alone. Many people want to grow their money, but once they hear terms like mutual funds, like treasury bills or stocks, everything becomes confusing. You're going to understand each of these funds and which of the fund you should pick. If you're a new viewer, subscribe to this community money talks so that you can get our videos every time we post. Now let's get into it. First, let's understand the basics, because to make the right choice you need to understand what each option really is. Let's start from the treasury bills, which is the second one. The treasury bills are short-term loans you give to the federal government, and in return, the government pay you a fixed interest at the end of the period. They are known for being very safe. This is why many people use treasury bills when they want stability and predictable returns. Please take note, treasury bills give a predictable returns. You know what you are getting, and any interest rate that is given to you before you begin, that is what you are getting throughout the tenure. It doesn't fluctuate, it doesn't go up, it doesn't come down. Okay, now let's talk about mutual funds. These mutual funds collect money from many investors. Then they invest it in things like stocks, like treasury bills. Let's just say they invest it in a mix of assets. This can include government securities, can also include corporate bonds, and sometimes stocks. A professional fund manager handles everything, which means you do not need to choose any investment yourself. The professional chooses for you. They look at the best assets. They look at the combination of assets that they can invest in that can yield profit according to the investment goals. Mutual funds are great for anyone who wants a hands-free investment with steady growth. What do I mean by that? I mean, on your own side, you don't have to do anything. You just put your money in any of the available mutual funds. Then you watch your return on investment. See how your portfolio, your investment on the mutual funds, you can see how they are performing. Now let's talk about the stocks. A stock represents ownership in a company. So when you buy a stock, you become a shareholder. Stocks offer the highest potential return, but they also fluctuate the most. Their value can rise and fall based on company performance, based on market conditions or investment sentiment. And now that you understand what the mutual fund is, what treasury bill is, and what stock is, how do all these investments grow your money? For the treasury bills, the return is fixed. Once you buy it, you already know how much you are getting. You already know how much your interest is. Take for example, let's say you invest 1 million naira and they give you a certain rate, a certain interest that, okay, if you invest this 1 million naira and the rate says you are getting 15%, you already know that for throughout the tenure, throughout your investment tenure, you get the 15%. The market cannot affect whatever you already are signed up for the treasury bills. So this makes treasury bills perfect for people who want a fixed income. It is also good for people that want short-term investment, because treasury bills are usually for a fixed term. So if you have a short-term goals or you want certainty in the amount of interest you want from an investment, treasury bills is a good choice. Okay, let's talk about mutual funds. Your money grow based on the performance of the asset. This is performance based. So based on the performance of the assets, that is how your money grow here. You know, the fund managers invest in government securities. If they invest in government securities only, the return will be steady and moderate. But if the fund invests in more aggressive assets like stocks, the return may be higher, but the movement will be more noticeable. There will be volatility in the movements. Let me make the explanation more basic. Mutual funds are of different type. Some of it invest in government-backed securities, government securities like Treasury Bills, like the government bonds. If that exact mutual fund type invest in that, then the return will be steady, the risk will be moderate. But there are other types of mutual funds that invest in equities like stocks. Those one, the risk may be higher. The return may also be higher, but because they invest in stocks, things that go up and down, things that are volatile. So you can experience sometimes when your portfolio will go up in price, and sometimes when you check your portfolio, it may have gone down. That is mutual funds for you. But what about the stocks? These stocks prices move up or down. They can deliver impressive long-term growth. If you are going to invest in stocks, you must be patient. Stocks reward the investor who is thinking long time rather than short time. Sometimes when you buy a particular shares of a company, when you are holding a stock, and maybe there are some economic shifts, you might experience a fall in price. Your stock portfolio might be down. But don't forget that economy rise at times, economy slows at times. So if you don't sell at that time at a loss and you hold on, when the market rebounds, you may begin to see more profit in your stock holding. But if you sell at a loss, that means you lose part of your fund in that investment. That is why stock is good for those people that are thinking long time rather than short term. See, I want you to understand the risk very clearly. What are the risks? Let's talk about the risk of each of these investments so that you can know which of it is the best for you. For the treasury bills, your capital is protected and your return is also predictable. You know what you are getting. In fact, on the treasury bills, you get your interest upfront. So let's say you want to invest a 1 million naira for a treasury bills that pay, let's say 15%. That means before you even invest in it, you will have get your 150,000 naira. And at the end of the tenure, you are getting 1 million naira back. Do you understand? So on the treasury bills, it is fixed. Your capital is protected and your return are predictable. Now, what about for mutual funds? What are the risks attached to mutual funds? For the mutual funds, the risks depend on what the fund invests in. Money market funds, which is the MMF. MMF is also stable, very stable. And if it is a bond fund, you know, I told you that for the mutual funds, there are different type of it. So depending on what you invest in, if it is a money market fund, it is stable. If it is a bond fund, bond is also moderately stable. If it is equity funds, that one move more because stocks move more. Stocks go up and down. And now let's talk about the risk. What are the risks if you are investing in stocks? Stocks can go up, they can go down. But over long periods, stocks tend to deliver strong growth. The important thing is this: risk is not good or bad. It only becomes a problem if you choose an investment that does not fit your personality or goals. I have explained the treasury bills, the mutual funds, and the stocks. You know the risk of each of these investments. Now the question is, which one should you pick? Let us make this extremely practical. Choose treasury bills if you want safety and predictable returns. Also, if you want stability, choose treasury bills. But choose mutual funds if you want professional management and you prefer stable growth without doing any research yourself. Just put your money in the mutual funds, any type of mutual fund you choose. Then every day, you just log in and check how your fund is performing. nothing from your side. The professional do everything for you. But choose stocks if you want long-term wealth and you are comfortable with price movements. You can even combine all these three: the treasury bills, the mutual funds, the stocks. And this is what many smart investors do. They do this to balance safety, to balance the steady growth and long-term gains. You can make a smart decision by asking yourself these three simple questions. Number one, how soon will I need this money? If you need your money next month, that completely changes the type of investment you are going to pick. If you are investing for some years, that also determines which type of investment you are going to pick. And another question you should ask yourself is, how much risk can I handle comfortably? You know that each of these investments have a certain risk. Now look at the mutual funds, the stocks, and the treasury bills. The risk of the stock is more higher than treasury bills. It is also more higher than the mutual funds. So how much risk can you handle comfortably? Do I care more about stability or long-term growth? Your honest answer will guide you to the right option. If you care about stability, we've already discussed treasury bills. We know that you are getting a fixed return, a predictable return. We've talked about stocks, which gives a long-term growth. When you answer these three questions, how soon will I need this money? How much risk can I handle comfortably? Do I care more about stability or long term? If you answer these questions correctly, if you are honest with the answer, this will determine the type of investment you are going to pick. Choosing between mutual funds, treasury bills, and stocks does not have to be confusing when you understand how each one works. The decision becomes very simple. The best investment is the one that matches your goal, your personality, and your timeline. Let me know in the comments, which of these investments do you think is the best investment for you? Is it the mutual funds? Is it the treasury bills? Is it the stock? If you find this video helpful, please subscribe and also share this with someone. Please also like this video so other people can know about this topic. Thank you for watching this video, and I see you in the next one.